rates. So that makes holding dollars more attractive. Then when you have turmoil geopolitically, people, internationally tend to like to have dollars. And another thing that creates dollar strength are trade deficits. So to the extent we run bigger trade deficits, that creates more demand for dollars. And economically, this makes total sense. So if I buy something, let's say that is from a German manufacturer, so they're in euros, right? So basically, I am buying their good. And what they have in return then, I mean, it gets there through different ways, but it's a zero-sum game. Basically, I'm giving them dollars. So now they have they, at the end of the day, have to have dollars in return for what I bought. So trade deficits create capital surpluses here, which create demands for dollars. And that ebbs and flows. And if you look at
Yo, this is Christian D. Evans with Journey with Christian D. Evans podcast. Guys, thank you so much for tuning in and listening to our amazing podcast. This is where we reveal the top 1% of business concepts and systems and processes to scale 8 and 9-figure businesses. We interview top-level 8 and 9-figure CEOs, business owners, and amazing TEDx speakers like David Meltzer. We got Nick Cavuto, Pascal Bachman, and so many others. And if you feel like this resonates with you, please share this with your friend, your family, and make sure you impact them as well, because we're trying to spread the message on those that do not know how to scale 8, 9-figure businesses and talking higher level business concepts. So guys, remember, enjoy the episode and be uncommon if you can. Cheers. Thank you so much for tuning in to Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans. And boy, we have a very special guest on today. My guest is the president and chief strategist at St. Louis Trust and Family Office, which they manage almost $15 billion for multi-generational wealthy families. They provide holistic, high-touch client service combined with customized independent investment management and a full range of family office services. And their focus is to construct a financial strategy that achieves both short and long-term goals. Though we're going to be talking about his book today, The Uncertainty Solution, and unpacking this, which you guys are going to want to send this podcast episode to all your friends and all your colleagues and everything like that, because as well as get this book, because this is really remarkable. Charles Schwab, which is the co-chairman and founder of Charles Schwab Corporation, says this about his book: The Uncertainty Solution is a must-have addition to anyone's reading list who is interested in developing habits that will make them a more successful lifelong investor. Please welcome my next guest, John Jennings, which is president and chief strategist at St. Louis Trust and Family Office. How are you doing today, John?
Hey, Christian, I'm doing great. And I'll tell you, getting that endorsement from Charles Schwab was really, really cool. I was really excited to get that, because as you can imagine, when you get endorsements for books, I've just learned so much about publishing a book. Like you ask people, would you read my book and would you endorse it? And that's a big commitment. It's a big ask. So having him endorse it, really was cool.
Well, let's dive right into it, because you talk so much about this stuff, and what's so interesting about this, John, with your book is I learned so much, because it's like these principles, these things that are consistent no matter what, right? And because of the trajectory of what's going on right now, this is so applicable. And you talk a lot about kind of recently COVID happened and the biases and the human behavior. But I want to ask, John, for those that are wanting to get into this uncertainty, right? This book and consuming the book, what are some of the big key takeaways that you wanted people to take away from this book when they consume it and read it?
Yeah, and first let me say real quick that the book is not out yet. So it comes out May 3rd. And if anybody is interested in the book and wants to have information about it being released, they can jump to my website, which is simply John M as in Michael, which is my middle name, Jennings.com. So that'll have information on my book, and that website's going to be built out over time. But really the whole gist of the book is really came about when after the financial crisis, when I realized just drinking from the fire hose of data and information, just the torrent of information that comes out about the economy and the markets every day, was actually counterproductive for me as a wealth advisor and as an investor myself. It really was driving me nuts, and I really didn't see the financial crisis coming. In retrospect, it's obvious, right? But at the time, I didn't see it coming. And I figured, well, there has to be a better way. How is it that great investors do what they do, right? How do they have great returns over time? And what separates an investor that's an expert from one that's not? And after a decade plus of research, I read books and books and books and white papers, and I uncovered that great investors create mental models in their heads, a lattice work of them that they fall back on to help them make decisions, give advice, and their behavior. So that's really the gist of what the book is. And part of that was noticing, experts at our firm, how do they advise clients? And it's not so much, hey, here's exactly what's going on in real time in the stock market. It's more like a Warren Buffett, his wisdom of be fearful when others are greedy and greedy when others are fearful. That's that covers 70% of what you need to know as an investor right there.
Well, you go into a lot of detail, and in the first chapter, you talk about the difference between, like you mentioned, data versus wisdom, and the wisdom hierarchy for their audience. And I want you to kind of unpack that for our audience, because you really go into amazing detail. And let's just start with that, because you build the foundation for everything else in the book with that.
Yeah, absolutely. So there's this concept called the wisdom hierarchy, which takes, I'll call it information, but we're going to break it into 4 separate sections. And it's a pyramid. And at the base of the pyramid, what's most plentiful and least useful is data. And I'll give you an example of what that would be. It would be housing starts in the US. So it's just this data. You have it and you can, pull things out of it, but basically it's just housing starts, not incredibly useful. But you can think that data streams like that are everywhere, right? Information would be taking data and organizing it in a fashion that it's easier to analyze. You can start drawing some conclusions from it. So if you take housing starts and say, let's look at it by the price of the homes. So, whether the housing starts are going up or down at the plus $1 million versus plus 500,000 tells you a bit about what the economy is doing. You can look at single family homes versus multifamily and apartment buildings. You can look by zip code to see whether, is Jacksonville, Florida, increasing or decreasing versus St. Louis, Missouri versus, Oakland, California, right? So that tells you information. That's good information, right? Okay, then you move up. So you had data, then you had information. Knowledge is taking information and data from other areas and putting it together to have a bigger picture view. So if you take housing start information and you pair it with, say, unemployment claims or inflation, interest rates, GDP growth, different things, an economist or financial analyst can say, here's in general where we might be in the market cycle, right? Wisdom is knowing what to do with knowledge. So a wise investor or economist will know that you cannot time market tops and bottoms successfully, consistently, and that they often go in either direction longer than we expect, yet sometimes, like with 9/11 and with COVID, they can turn on a dime, right? So that's the wisdom of it. And really what I do in my book with these investment mental models is give investors, and it's actually beyond investing because there's a lot that just have to do with making decisions in life, give them an express elevator up to the wisdom, right? Most of these mental models are nuggets of wisdom that help you make decisions in the face of uncertainty.
And you go on and talk, and we're going to be talking about this here shortly, the difference between the certainty and making sure that you are being aware of those analysts and those other, predictors, right? And, seeing the kind of the fallacy of those situations, and which I found very interesting when you were kind of diving into it. But I want to talk a little bit about Hanlon's razor thoughts. Explain that a little bit further for our audience, and then explaining how you're able to, why so many people struggle with that specifically.
Yeah. So the entire topic of mental models, or this as a concept, was championed and probably created by Warren Buffett's business partner, Charlie Munger. So he gave a speech in 1994 at USC's business school. And really, he was answering the question, how do you become a worldly wise person? And he said, what you do is you create a lattice work of mental models. 80 or 90 of them are, he says, will carry most of the freight. And when he's been asked over the years about mental models, and like give an example, one example he's given is Hanlon's razor. So a way to think about this is, have you ever sent an email and then the person hasn't responded? And maybe even sent a second one, they haven't responded, right? So it's easy to jump to having hurt feelings or maybe even anger, like you feel like you're being blown off or you're not important. But that's a perfect example of where to apply Hanlon's razor, which says the following: never attribute malice to that which can be explained by stupidity or carelessness, disorganization, sloth, whatever. And if you think about it, that's such a valuable way of thinking about human interactions, because with rare exception, unless you're, a teenage girl, there, people don't intend malice. And I say that by having two daughters in their 20s, kind of went through that, time period with them of, mean girls abound. But, people don't intend malice in general. It's rare. So, but yet we tend to jump to that because we have, heightened threat sensitivity as part of our survival mode. So if you can apply that when, if somebody ghosts you for, a lunch meeting, or, your brother forgets your birthday, or someone cuts you off in traffic, I mean, it's just a great example of a way to view the world. And since I learned about this mental model, I don't know, probably about 10 years ago, I apply it all the time in my life. And I feel that it helps, preserve my emotions and sometimes even relationships. And I hope people apply it to me when I don't reply their emails or I mess up.
So explain this, how they could apply this to kind of the thought process with investing in that paradigm, in that perspective.
Yeah, I don't know that Hanlon's razor in particular is all that applicable to investing, but learning about mental models from Charlie Munger is really one of the key pieces, that along with the wisdom hierarchy, that I realized that there's mental models like Hanlon's razor that exists in investing, and that expert investors use, and they know which ones to pull out when, in order to make decisions when faced with uncertainty, or even if uncertainty isn't really the major cause of their distress, which ones to pull out when. And I've observed this over and over and over with investment managers we use and with different people at our firms. And I've been able to contrast that with people that are in the financial industry that I've just seen are just in the data and information realms. They don't have these vigorous worldly wise, as Charlie Munger would say, mental models. They're just caught up in the drinking from the fire hose of data and information. So
Yeah, I love what you're saying, because you're able to implement these, and because the whole book, and this is the way I thought about it, it's not like how to invest, right? These strategies and the new tactics and the new, hedge funds, whatever. It's really how to think about it holistically. And what I love about that approach is that no matter the test of time, no matter if it was 2008, no matter what, no matter 2050, right? Whatever that looks like, these are consistent principles. And you talk a little bit about this, and I thought this was very interesting conversation a little bit, where the importance of not using the stock market as the economy, as the baseline, because you're saying, and you go on a little bit further where it's like, hey, good news, but the stock's down, right? The stock market's down. And bad news, but the stock market's up. And so there's like this, it's bizarre, and it doesn't ever have any consistency.
yeah, if there was one investment mental model that people listening to this podcast, or people who would read my book, or I write articles and forums on these topics, I think the most important takeaway for investors is that the stock market is not the economy. So what's fascinating is that there are not economic indicators. There are no economic indicators that consistently, other than randomly, tell you what the stock market's going to do. So you can't look at GDP growth or economic news to inform what the stock market returns will be. But what's interesting is if you look at the correlation between GDP growth and the stock market, it's basically zero. Since my birth in 1970, it's like 0.03 or 0.04. So basically zero. But if you look at the correlation between last year's or a prior year stock market returns and a current year GDP, it's much higher. It's somewhere between a 0.4 and a 0.6. meaning that, really what that tells you is that the stock market moves in advance of what's happening in the economy. And we've seen this over and over and over again, where, in the midst of COVID, we'd only had our 1,000th COVID death reported at the bottom of the market in 2020. Like, if somebody had said to you on March 23rd, 2020, hey, Christian, guess what? Guess what's going to happen? Over the next few months, things are going to get much worse. Deaths are going to spike. International travel is going to be shut down. You can't go to Europe. Not only that, you can't go to Canada. I mean, the Canucks are like, we don't want you, right? Like, entire industries are just decimated. Travel and hospitality, restaurants. We're going to have huge supply chain shortages. Unemployment is going to spike to nearly 15%. What we think right now might be a short shutdown is going to go on for nearly 2 years. Like, my tendency, without knowing these mental models, would be like, okay, I got to get my clients' money out of the stock market. And I'm going to take my own money. I'm going to put it into cash or gold. I'm going to bury it in my backyard. But from March 23rd till December 31st, 2020, the stock market was up 70%. Like, there's no way you could possibly foresee that, other than this mental model of you cannot look to the economy to tell you what the stock market's going to do. So I wrote an article in Forbes on this exact point on March 26th of 2020, 3 days after what ended up being the market bottom. And it said, just because we're entering a bad recession or maybe even depression does not mean you should sell the stock market, because the stock market's not the economy. And I made these points. And I've had people say to me, wow, you called the bottom. How did you know? And my point is, no. I didn't call the bottom at all. I just said, you can't possibly know. It was like, I don't know what the stock market's going to do. It wasn't, I know that it's a bottom. It was the absolute absence of knowing anything that should inform investment decisions when you don't know. So what we tell our clients is, and I'm doing with this book, I want this message out there, is just because economic or geopolitical news is bad doesn't mean that the stock market's going to do poorly. They have no current relationship with each other. So who knows?
And that's what I find so interesting. I think Ray Dalio talks a lot about this, when they got off the gold standard, and he's like, it's 100% going down. And then all of a sudden the stock went back up, and the S&P was fine. So it's just, I find that so interesting how accurate that is. But then when you're able to use that principle for future use as well, he's like, okay, well, I know that, hey, whatever comes out, I'm going to stay the path, like you mentioned. Now I want to talk a little bit about, because you dive into this, I thought this was, you clarify and simplify this tremendously, and you were able to be like micro with this, your control bullseye. Okay. And you go in and talk about the control and influence, the influence, but no control, and then no control and no influence. And you kind of have 3 increments, and you kind of micro in each one. I want you to kind of explain the premise of it first, and then I'd love to talk a bit about it. And of course, I've got my notes here if, what control, which each one of those kind of focus on what we need to focus on.
Yeah. So we're all, especially in today's internet era and social media and everything, we're under a constant barrage of noise. The vast majority of which, and by noise I mean data and information, the vast majority of which doesn't help you to be a better investor. In fact, it'll make you be a worse investor. So we have developed a schematic, which is really more of in its of itself a mental model or thought process that we use with our clients. And it looks like a bullseye. And you focus on the bullseye first, and then you move outward. And at the very center is things over which you have control. And when it comes to investing, the 2 main ones are fees and your own behavior. And that's it, right? And later in the book, I get into what good investing behavior looks like. And then fees are difficult too, because sometimes it's really hard to know exactly what you're paying, because there's all sorts of different layers of fees and things that happen, and really fees can be devastating to a portfolio. So we focus the most on fees and behavior. And I'll tell you, if you get fees and behavior right, you will be a successful investor as compared to, I don't know, 90+% of the investors out there. So the next thing that you we advise our clients to look at, we help them look at, are things over which we have control. No, not control, excuse me, influence, but not direct control. So you can influence the taxes that your investments generate. You don't have complete control, but you can invest in more tax efficient versus less tax efficient vehicles and influence how much your tax bill would be. And just like fees, taxes have a devastating effect on overall wealth. And an issue with the financial industry, the investment industry, is there's no system to report after tax returns. I mean, Morningstar does look at, for mutual funds, kind of what their tax drag is, using kind of some crude tools. But when an investment manager or a wealth management firm reports to their clients, they report on gross returns or maybe net of fees, but they don't report net of taxes. And in fact, the investment manager almost never knows what the tax effects of the portfolio are because he doesn't see the 1099s or the K1s. The tax accountant does. So, on April 15th, or these days more like October 15th, the client looks at their tax return and goes, oh, holy cow, look at all these taxes. But, how much of that are taxes that could be avoided by, smarter structured investments in terms of taxes, is often ignored. In fact, most investment professionals know very little about taxes. It's kind of extraordinary. The other thing that you can influence but not directly control is the amount of risk your portfolio takes. So that's an important thing to focus on. And then the outer level of the bullseye is pretty much anything else. I mean, it's, what's the market going to do? You have no control over that. In fact, it's, largely unpredictable. I mean, it moves in cycles, but you can't time it. Geopolitical events, I mean, who knows? Technological innovations, things that look like they come out of the blue that are going to affect the world. And I think it's so important to, as a wealth advisor, or even just as a human, to understand what you know and you don't know, and what you can control and you can't control. So let me tell a little story if I can. So this spring, I think it was like early March, I was on like a spring break trip with a bunch of other families, and all the guys, we went on like this fishing trip. And I actually don't fish. I was just kind of along for the beer. And one of my buddies who works in the financial services industry, the boat captain said, oh, what do you all do? And we all kind of said, he's like, oh, you seem like a smart bunch of guys. And, the war in Ukraine was, just heating up, right? And he said, what do you think is going to happen with Russia and Ukraine? And one of my buddies, who's in the financial services industry, actually gave an opinion. And then the guy, a little bit later, was like, what do you think is going to happen with inflation? And my buddy gave an opinion. And I will tell you, sitting there, like, it almost doesn't even matter if he was right or wrong. I would have been so much more impressed with his intelligence if he said, I don't know. Who can predict? Like, I didn't predict that Ukraine would be, invaded by Russia. And if he would have said, I've gotten, my views of inflation and interest rates have been more wrong than right over the last decade, because how could they be otherwise? I think there's a real ability to have the humility to admit when you don't know, and that's a huge message in my book to investors and to wealth advisors, which is, know what you know what you don't know. And if you don't know and it's unknowable, to say that's not knowable, and to boldly go forth and invest, admitting your ignorance is better than to go forth thinking you know things that you don't. So there you have it.
Well, and I appreciate you saying this, because even though it's unorthodox, you and I know, you kind of discuss this a lot, that people gravitate towards certainty, right? And we're going to dive into causality versus correlation, and which is going to be what you kind of unpacked there. It was really, really quite remarkable. But people gravitate towards certainty. So whether it's an analyst that's totally wrong, whether it's a PhD or whoever, whatever, right? Whether it's the Fed, right, the chairman, and they say certain things and they don't know. Nobody really knows, but people like certainty, even though it may not be the right answer, in which you just mentioned it's not, because nobody knows. And like you mentioned, you respect people that have humility. But let me ask you, because you're seeing, and that's why I think this book is so important right now. how do we as investors, as people that are going through our life, ensure that, okay, hey, we realize that that's a red flag, and we realize that we are biased toward finding certainty, even though that may be inaccurate.
Yeah, that's so hard to do. So, as humans, one of our primary motives is the resolution of uncertainty. So we've evolved as a species to want to recognize patterns, which makes total sense, because if you can recognize a pattern, it helps you predict the future, right? Because you see the beginnings of the pattern and you know how the rest of the pattern is going to be. It's fantastic. And you can see how that'd give you a survival advantage. Like, are those berries or mushrooms, are they poisonous? Are they nutritious? Is that rustling in the hedges? Is that a predator? Is it prey? Seasonality, things like that. All those things gave us a survival advantage. So our ancestors that were better at recognizing patterns survived longer, which allowed them to reproduce at all or more, which selected for that. And we are their descendants. So we are these profligate pattern recognizers. It's amazing. But the flip side is that when we can't recognize a pattern, it makes us anxious and causes stress, which makes total sense from an evolutionary standpoint. So what we do is we become hypervigilant. Our sympathetic nervous system is triggered, and we look for a pattern. And when we find a pattern or we resolve the uncertainty, it doesn't always have to be a pattern. The end result, the result happens. We feel pleasure. So our parasympathetic nervous system kicks in, which is the relaxation response. We get a dose of dopamine, which is pleasurable. So we feel good. So we have this sort of complex relationship with uncertainty, where uncertainty makes us feel anxious and stressed, but getting rid of uncertainty makes us feel good, which is why we like a little of uncertainty sometimes. Like, we don't want to know the ending to a movie, and we'll read a book that's a mystery, and some of us like to gamble, right? Because we like that hit of dopamine, right? So we have this underlying quest for certainty that happens mostly subconsciously. So we don't realize it's even happening. And there's certain things that we do when we're faced with uncertainty. Like, so we flare around and do what's called seizing and freezing. So we're looking for an answer. And we tend to grasp the first explanation, because we love explanations because it gives us certainty. It's like we recognize what's happening here. We look for the first answer that fits our worldview. So that's seizing. And then we freeze on it because we don't want to revisit the uncertainty. And I think COVID has been fascinating in this regard. I've just really been interested in seeing people's views on COVID, because what happened with COVID is we learned a lot over the course of the past few years, right? So it started and it was like, oh my gosh, this is horrible. And then it was like, oh wait, it's not killing as many people as we think. Oh, it's still a lot of people. And then you had the whole, our vaccine, we have these vaccines and they're good and they're bad, or we should mask or we're not. But it was largely along political lines, but people were looking for certainty in the face of COVID. And so a lot of them grasp explanations that fit their worldviews. And I've seen it on both sides of the political spectrum. You had people saying, this is just like the common cold, therefore I'm not going to put this, experimental vaccine in my body. And anybody that does is crazy and you can't make me. And on the other hand, you had people that said the vaccine is our way out of this. And we have to have it. And, didn't want to read anything about side effects. And then once the virus changed, it was no longer as effective. You still had people like, oh, if you don't vaccinate, you're a Nazi or whatever. So you had these two completely different views, and really what people were looking for is certainty in this incredibly uncertain situation, which is a horrible situation. Regardless of your political views, a lot more people died over the last 2 years than were normal, and life expectancies come down. So, we had this horrible situation, and people had the season and freezing. And then another thing we do is we look for information. So I did this in the financial crisis. I spent, like 5 hours a day reading, trying to find the way out of the financial crisis. How is this going to end? And I did the same thing during COVID. And so many people I know did, which they spent just, all this time every day looking for information that was going to, tell them what was going to happen with this, this pandemic. And so we flail around there. Another thing we do is we associate with groups that think like we do. So we stratify into social groups. And I think one of one of the most interesting things I have ever read about how people view the world is from this sociologist, Ari Kruzlansky. I probably pronounced his name wrong, but he says the truth is whatever your social group believes it to be. I mean, just think about that for a second. So, I mean, it explains why you can have all these different religious views that people are, completely certain about. It's why you can have sets of people that say the election is stolen and the other people say that it's not, right? It's why you could have people say, you have to mask and others say that masks are ineffective. I mean, the underlying data or, facts be damned, you will believe what your social group believes. And if you start having different views than your social group, you tend to change social groups. And the more uncertain you feel, the more likely you are to associate with people that have similar or more extreme views along the lines of yours that you do. And so that's explains so much why we have these, further stratifications in our society as we feel more and more uncertain. So, it's all, I think, quite fascinating how we typically react to uncertainty. But what we have to do is recognize we're feeling uncertain. And a great thing about being human, in addition to our opposable thumbs, right, is that we can use our brains to shape our behavior to overcome our instincts and our subconscious. So it's really, recognize when you're feeling uncertain and saying, okay, there's these things that I usually do when I'm feeling uncertain, and I'm not going to do that. And a big one is listening to experts, because when we hear a confident expert tell us what's going to happen, we feel like we've had the uncertainty resolved. So when you hear somebody on CNBC and they say, oh yeah, the market's, we're at a market point inflection where we're bottoming, or, here's what's going to happen to inflation over the next 3 months. We feel like we've achieved certainty, even though that usually is not the case with an expert prediction. So that's what we usually do. I'll stop. I could
No,
go
and
on.
John, well, that's I appreciate these examples, and you go into such beautiful in depth and research in regards to these examples in your book, and we're going to talk a little bit further about bias and that protective bias. Like I think you go into a lot of data and saying, hey, when you lose money, it's a 1.5x kind of emotion more so than gaining money, right? And you go into a lot of that, but it comes back down to that human behavior. One of the things that I appreciate so much about this book is it's not like really oh, how to do this and how to do this and how to navigate this. It's more of like, okay, hey, being aware of your own behavior, so that you become like, okay, hey, you know what, I'm getting in a situation where I'm becoming biased, or I'm in this uncertain thing and I'm grabbing on certainty that logically doesn't make any sense in that circumstance, right? And now I want to kind of loop into causality versus correlation, because this is a very interesting concept that I found you actually explain in your book here about women run leaders, right, in the VC world. And you thought, okay, and you got data, and you were going to almost invest a lot of money because you started seeing the data. And then I think a billionaire friend said, hey, is this a correlation or is this a causation, right? Was because this, was it a direct causing, or was it just correlated, and just like, was it any data associated with it? Help us understand that story and the difference between it.
Sure. Yeah, so one of the chapters in my book is called "Looking for Causes in All the Wrong Places," and it's about causation and correlation. And me saying that right there probably doesn't make you want to run out and buy the book, right? But I try to make these topics more entertaining than they sound on their face. But everybody knows that correlation isn't causation. I hear people all the time, especially in the financial world, say that. But it's really hard for us as humans, because again, we're looking for patterns and we want explanations. And when we see two things that seem to move together or move opposite of each other all the time, we tend to assume that there's causation there. And the story you're talking about is in the realm of sometimes things have common causes. So they don't necessarily, one doesn't cause the other, they're caused by a third factor. And so what happened is I was at this conference years ago, and I was talking to this woman who ran an investment firm, and she told me about what they did. And what they do is they only invest in companies that have female leaders or strong female leadership on the board or in the management team. And she's like, because female-led teams outperform. I was like, holy cow, that's amazing. So I researched this and read all these studies, and she was exactly right. So female-led firms had this strong outperformance over male-dominated ones. In public companies, private companies is pretty amazing. And these research papers I read said there's reasons for this. Women make 70% of the consumer choices. So women are more in tune with what, the vast majority of consumers want. And women in general are more risk adverse, so they don't have as many blow-ups. And in terms of, being, stereotypically more, having more maybe EQ, so there was all these reasons why women leaders might be better. I was like, this is amazing. Maybe we should add her strategy or there's even index funds that do this, right? So maybe we should do that. So I was starting to talk to our investment committee about, let's dig into this. And I met with a client of mine who used to be the CEO of a Fortune 500 company. And he was like, are you sure there's causation there? Or they just could be correlated or something else going on? I think you should dig in more. So I did. And what I found is that there were these other studies, one from a professor at Northwestern, another by a psychologist, that suggest, maybe cynically, that the data doesn't suggest that women-led firms create outperformance, but that outperforming firms tend to hire more females in leadership positions. And this one psychologist put it like this. He said, maybe it's kind of like, firms using different strategies for PR. He says, maybe like, recycling their annual reports to say that they're more green. Maybe once you're successful enough financially, you can afford to signal that it's important to have women, and that maybe companies that aren't doing as well aren't focused on gender or ethnic diversity. They're just focused on trying to make more money. And, the jury's out on this. It's interesting, since that conference, the index of women-led firms has struggled and actually underperformed. I'm not saying that women don't make better leaders. And I'll tell you, we're a female-led firm. Our CEO is female. Half our management team is female. As a firm, we're about 70% female. And I'm a big fan of female leadership. So I'm not suggesting otherwise. It's just that I had jumped to this conclusion that there was causation, where the data suggests that maybe there's a common cause, that being a high-performing firm causes you to want to hire female leaders, not the other way around. Interesting, I think. Well, of course, I think these are all interesting. I'm self-selecting here.
But that's why I thought it was so incredible that you brought and unpacked that, and I'm curious when you're looking at it, and because I want to help our audience, because that was a good example and helped you unpack that for us to understand the difference between it. But when you're kind of maybe even in your own firm, when you're looking at a decision or investment strategy or alternative or whatever, what's that look like a little bit to ensure that you are not saying, okay, this is the cause, and making sure that there are red flags, and you're like, okay, it's not checking all the boxes, and making sure that, okay, hey, I'm putting this in the right context to ensure that you're not falling into that trap. You know what I mean?
Yeah. So what we really do, the main thing we have is just a big dose of skepticism. So we try to approach every investment strategy in every investment decision with skepticism. And especially when it comes to causation versus correlation, because there's this great website called Spurious Correlations, and it has, I don't know, probably 100 different examples of things that are highly correlated. So one I mentioned in my book, not from that kind of started this whole spurious correlation, there was a study by these economists that showed that the correlation between butter production in Bangladesh and the U.S. stock market was like a 0.98 or something. So like whenever butter production was up, the stock market was up, and vice versa. And it's spurious. There's no relationship. Like the number of 9-year-olds in the US completely predict what the stock market is going to do as that rises and falls. And you hear this more broadly, like, if the AFC wins the Super Bowl versus the NFC team, that affects, what the stock market is going to do. And even things like, what the stock market does during different election years and things like that, you got to just be real careful about attributing causation, and you got to think about the number of data points. And I think another thing is most studies of the stock market really only go back to 1926, because that's kind of the birth of really the more modern stock market. And when you started having indices, and that's when you started having Dow Jones Industrial Average and good data in the S&P, and it used to be like the S&P 80, I think, than it was the S&P 500. But if you think about it, like, that's less than 100 years. And if you're looking then at things like recessions and bear markets and bull markets, or presidential election cycles, like, that's not a ton of data points, right? And it's during this time period where we've had this expanding and growing population, and you have different things going on. And I always use the example with clients of Japan. So Japan looked like it was going to take over the US in terms of economic might back in the late 70s into the 80s. And you remember, like, Christmas is coming up, and I think probably the best Christmas movie ever is Die Hard from 1988, where you have Bruce Willis playing a detective that there's terrorists in this big building in Los Angeles, and they're stealing these $640 million or whatever it is of bearer bonds and whatever. But the corporation was called Nakatomi Corporation, because of course in 1988 any super successful corporation with nearly $1 billion of bearer bonds, of course, would be Japanese, right? But what happened is in 1989 the Japanese stock market peaked, and it hasn't still regained its 1989 peak. So I think it's important as you look for patterns in the world to realize that patterns can continue and then they can change, and we just keep that in mind, and that things can change, and to be skeptical about things that have worked in the past working in the future, because maybe they were just correlated, or the world changes, the markets change, people learn and adapt. Over the next 100 years we're going to be faced with a very different demographic situation than we did during the 20th century. You had the baby boom, and you had this increasing population both through immigration and organically in the US. And over the next 100 years, really in the US, our population would be, stagnant or shrinking if it weren't for immigration. And that's only going to get worse in all of the developed world, everywhere but Africa, it's predicted. And what does the world look like with a declining population base and aging workers? Like, we don't know what that looks like. So you look out to the future, and everybody knows this, but you look out to the future, and you gotta kind of say, the patterns of the past may not persist the same way in the future, because we're reaching this inflection point with respect to population. It's really fascinating.
Well, I'm curious on this because I do know that obviously we focus a lot of the investments in the U.S., right? And I'm curious, just on a geopolitical stance, what are you thinking in regards to internationally? I know China, you got Japan, you got India, even, making massive growth trajectory. How do you think? And I know this is just kind of an idea of what this looks like, and this can get off the book a little bit, but I just want to get your perspective on how that's going to play into maybe some of the investment strategies, whether it's alternative or whether that's some of their indexes.
Well, I think the first thing to keep in mind is when you look at country growth, and you can look at some of the emerging market countries that are projected to have over time, a lot bigger economic growth than the U.S. You have other areas, especially in some areas of Europe and in places and where the growth is predicted to be reduced. And a way to think about like GDP growth, to step back, is it's consumption plus investment plus government spending, plus net exports, right? But really the way to think about it is it's really driven by two factors, and it's population growth and productivity increases, right? So to have your country's GDP go up, it's a combination of the two. So if you have a declining population, you can still have increasing productivity, or GDP, if you have increasing productivity. And if you have declining productivity, you can still be increasing by, increasing population growth. And you can look at a country like China that, like 100 years ago was, really backward in every sense of the word, right? and now is, the second largest economy, and has been growing much faster than the US for about 50 years. And they had both things going for them. Like, so they had the population and growth, that was exploding, that they, obviously instituted the one child policy about 50 years, or I guess 40 years ago. But then huge productivity increases. So you look at China, everybody's like, okay, maybe they're going to get old before they get really rich. And you look at Japan with their, declining, population, and, the productivity comes from technology. So I think that's, first of all, that's an important way to think about it, and how population will have an effect on economic growth globally and within country. But a second thing that really important to keep in mind is that a country's GDP and their stock market returns over time tends to be negatively correlated. And if you think about that for a second, at first, it seems crazy. It's like, if a country's growing faster, you would think that their stock market would be a better opportunity. But really, it makes sense that if all you had to do is pick the stocks in a country that was faster growing, you would outperform, then everybody would do it. And then if everybody would do it, that ability would go away, which is what happens. So the conundrum here, and there's been studies over the year. I read a great one from Northern Trust a few years ago. ABN AMRO, had this fantastic study on this, and economists have looked at this conundrum for a while, and it really has to do with the pricing, right? So if you're in a faster growing country that's going to be expanding, then the price of those stocks are bid up because of the potential growth, or the stocks of companies that are selling in. So you look like a company like Nestle, they sell a huge amount, a big proportion of their sales are to these fast growing emerging companies, right? So you can look at Nestle and say, I'm going to sell to Nestle because they're selling to all these emerging and frontier, countries. But everybody knows that. Therefore, it raises the price of the stock, which reduces the ability to make outsized returns from it. So when we look at international investing, we set aside this notion of just invest in the fastest growing countries. It's really oftentimes the slower, it's like being a value investor. Often the companies of a slower growing economy might be underpriced. So in terms of investing outside the US, we have been wrong for 12 years now. So we continue to allocate to international, and we continue to advise our clients to allocate to international. And as the US does better than international, we have them sell out of international, or out of domestic, and buy international. And it has trailed consistently for about 12 years now. And and prior to to the financial crisis, it outperformed nicely. And it used to be great. I used to be able to sit with clients and go, oh, guess what? Even though you're, say, 20% in bonds, you're still beating the S&P 500 because the reduction in overall volatility from bonds has been nice, and actually adds to your geometric returns. And international's outperforming. We have emerging markets that's outperforming, and small caps been outperforming large cap, and that's great. So you have outperformed the S&P 500 with less risk. Unfortunately, from our point of view, our portfolios in general have lagged the S&P 500, because unless you're in the S&P 500, basically everything else is underperformed. Bonds have underperformed, small caps underperformed, internationals underperformed, emerging markets underperformed. So unless you've had a really big dose of either a star manager, which would be really hard, or big dose of just huge returns out of your private investments, it's been really hard. And I'll tell you, we first and foremost, we're a family office. So we work with 63 families, and most of our families have money elsewhere, including us. And we don't care. We download, we report, we advise on it, but we download every night from 75 different custodians, and meaning, banks and brokerages. So we have all sorts of portfolios that are at Goldman Sachs and Morgan Stanley and JP Morgan and Merrill Lynch and Bessemer and Northern Trust, and on and on and on and on. Bank of America, US Bank. So what's so fun about that is we get to see not just what investment professionals say they do, we get to see what they actually do. We get to see the actual performance over long periods of time of all these major investment firms. And I will summarize what I think of all these firms' investment returns over time. There is no secret sauce. There's no secret
John,
sauce.
I appreciate it, but you're catching me off guard with this, honestly, because I thought because of the emerging markets and because I am looking at China, I'm looking at India, I'm looking at all these other countries, even Israel, for example, and their baseline is different, right? Baseline for US, where we're profitable, we're making money, but the growth trajectory is not as intense. We're not doing, you know, 2x, 3x, 4x, 10x, right? Where China and these other emerging markets, they have a higher, growth trajectory. So
They
that's
do.
why you're catching me off guard in regards to that. But you're basically saying with the data that you have, so I'm not going against what you're saying. You're saying with the last 12 years, they have underperformed the S&P consistently. And that shows to me, well, even though my human behavior thinks, well, I see something different, I'm going to go with the data on this. So I
Well,
appreciate you sharing that with our
well, and
audience, John.
I'll give you the argument to invest in international. And it's been similar to what we've been saying for years. Is first of all, the valuations of most international markets are less compared to their long run average than the US's is. So the valuations are less than the US, but historically they've always been less than the US. So you got to look at, compared to their long term average, how are they? And they're less overvalued. Well, I don't know if they're overvalued or not. They're less richly valued compared to their long-term average than the US is. And of the things that predict future stock market returns, price to earnings ratios is almost the only thing that has validity. But price to earnings ratios only explain about 40% of the variability of returns over the coming 10 years, right? So if you look at what factor predicts another, the price to earnings ratio have the biggest predictability over the coming 10 years of stock market returns, but only at about a 40% rate. So it's suggestive, but not dispositive, right? So if you look at price to earnings ratios internationally, those stocks look cheaper than the US stocks. Second thing is currency effects are huge when it comes to international investing. So this year, so far through Halloween, which is the last time I looked at the data, international stocks in their local currency have outperformed US stocks by about 10% this year. But because the dollar has been so strong, they've underperformed by, I think, about 5%. So there's been like this 15% swing based on the US currency becoming incredibly strong. And part of the reason prior to the financial crisis, kind of that decade prior to the financial crisis, international returns were so strong is because we had a weakening dollar. So the dollar just weakened consistently during that decade, which boosted international returns. And then the dollar's been strengthening generally, I mean, it goes up and down, but it's generally been strengthening over the last decade with a huge increase over the last 2 years. I mean, the fact that the dollar and the pound and the dollar and the euro got to parity is, I mean, think about what a huge change that is. I mean, I remember not that long ago where, the euro was like, it was like $1.40 per euro, right? And now, being around parity is just like, wow. So you have these currency effects that happen as well. And with the dollar's strength, trees don't grow to the sky. The dollar won't continue to strengthen forever. Part of the reason for the dollar's strength, I mean, there's a lot of reasons, but part of it is, us increasing interest rates. So that makes holding dollars more attractive. Then when you have turmoil geopolitically, people, internationally tend to like to have dollars. And another thing that creates dollar strength are trade deficits. So to the extent we run bigger trade deficits, that creates more demand for dollars. And economically, this makes total sense. So if I buy something, let's say that is from a German manufacturer, so they're in euros, right? So basically, I am buying their good. And what they have in return then, I mean, it gets there through different ways, but it's a zero-sum game. Basically, I'm giving them dollars. So now they have at the end of the day, have to have dollars in return for what I bought. So trade deficits create capital surpluses here, which create demands for dollars. And that ebbs and flows. And if you look at what's going on with supply chains and so many companies saying, hey, maybe we want to deglobalize a bit and control more of our supply chain, and you have things like the Inflation Reduction Act saying, hey, all these batteries and all these EVs, we want more of that made in the US. We could have a situation, I mean, I don't know, but we could be having a situation where we have a reducing trade deficit as we onshore, more things because of what we've learned about global supply chains during a pandemic, which would suggest maybe the dollar will start coming back down at some point in the future. So those are all arguments towards international. It's not so much that these international countries are growing faster. It's more looking at the valuation and then the currency effects of investing internationally. And I've been saying similar to this for years to clients, and every year they look at me and go, why am I still in international? Because it continues to underperform.
Wow, you laid that out very well, and I really appreciate unpacking each one of those, because those are incremental things that I did not think of when I'm having that strategy. But also, I like how you said you've already had 12 years of data to support this decision a little bit. And like you mentioned, you've got some people like, what are we doing? Why are we in this? Let's just stick with our plan. So I want to ask you real quick, John, you talk a little bit about in your book, creating great wealth, preserving great wealth. So in the creating great wealth, you say concentrated, higher risk, active personal involvement, and luck. And that's kind of where our audience is, right? They have 7, 8, 9-figure business, and they're wanting to scale, an 8 and 9-figure business even higher, right? And then there's a point at some point where you have to start preserving that great wealth, which is diversified, lower risk, passive involvement, and process. So help us understand that, because you do, unpack that quite a bit in your book. And I just thought that was a really cool emphasis, but also helping people realize at what point, maybe when they had an exit, or maybe when they're, kind of liquidating a few things, to reassess, okay, what stage am I in, and what that looks like, to making sure that they get in the right stage and the right pillar.
Yeah, so our average client family has a little bit north of $200 million, and we're mainly in like the $100 to $500 million range. We have some over 500. We have some less than 100. But so we have this really fun niche that we work in of families that are so rich that they have all this complexity and need a family office, but aren't rich enough that it makes economic sense for them to build out a full service family office. I mean, many of our clients have a, kind of a smaller family office, but that we work with them with. So that's kind of our niche. So a huge proportion of our clients, come to us because they either currently have a successful family business, closely held business, or they've sold one. So we have some corporate executives, that CEOs of public companies that have, cashed out, or we have people that had an ancestor that did one of the other two things. So all the time we're talking to a family right now that's looking to sell their family business, and 2 others this year sold their businesses and came with us. And a key mental model we talk to them about is how they got to the point they are. And I love asking people that have sold their businesses, like, how did this happen? How did you, either during your lifetime or over a generation or two, how did you create a business that is being sold for hundreds of millions of dollars? And they typically say, like, 2 of the top answers are, I surrounded myself with people that were smarter than I was and didn't get in their way too much. And I got lucky, right? And if you think about it, like, if you just make a lot of money, if you're like a lawyer or a doctor and you just save well and you invest, you can do well over time, right? But you're not going to vault into having, 50 or 100 or $500 million. Those are people that had a major equity stake in a company that was public or private, typically a founder of a private company. And what they did is, obviously they were concentrated. Almost all their wealth was in one company. They were not diversified at all. Maybe they made some money and they made distributions, they diversified some, but compared to their overall net worth, like if the company went under or didn't do well, they were not going to be fabulously wealthy. Then active personal involvement, like they are obsessed. They work all the time, nights, weekends. Often we'd see, that this is like the driving force in their life. It affects their health. It affects relationships, right? Like they built this business. It was their baby. And then they got lucky. Like things happen just so. Like I look at our company, which we founded a little bit over, and I was one of the co-founders, that as a principal back in 2002. Like somehow, some way, things came together just right to even form the business. We were formed out of the ashes of Arthur Andersen when it went under. A bunch of us worked at Arthur Andersen, and then we got a really large client about 8 or 9 months into being a business. And we had some clients that came with us from Anderson, but this one client moved us from unprofitable to profitable. And I have no idea why they hired us. Like, they should have. Like, we were this. I understand why people from that we were the trusted advisor Anderson went with us, but why did they? Why did these other people hire us? Like, how did this one client just happen? I don't know. It was, if that hadn't happened, I don't know that I'd be sitting here today at this firm. I would have maybe been doing something else. We might not have made it. But so we talk to our clients about that, and then just say, okay, now that you're selling your business, or maybe you're selling a portion of it. We have a lot of clients that'll sell, say, a private equity firm or a strategic buyer, and keep 10, 20, 30, 40% of the company. But it's like, okay, now what do you do now? Do you want to try to catch lightning in a bottle again? And the vast majority of them are like, no. Some of them are like, yes, I'm an entrepreneur. It's what I do. I want to start my next business. And great. And it's like, okay, how much do you want in each bucket? And the other bucket is, we call it preserving wealth, but you can still grow nicely. It's like, okay, we're going to be, instead of concentrated, we're going to be diversified, and instead of high personal involvement, we are going to be, passive, meaning that we're going to invest in other people's companies. And instead of luck, there's a lot of luck, but we're going to focus on process, right? So we're going to do all those things. It's not nearly as fun. It means probably doing a lot of index funds. It means probably having some bonds and some cash and, maybe some private equity, but other people's funds. It's not nearly as fun. And you're just not going to make the same sort of returns doing that as you are creating your own company and vaulting into hundreds of millions of dollars. It's just not going to happen. And I think having that expectation is important, but it also means that it's not going to go to zero, which is what most companies do, right? Most companies go to zero, and you're not going to go to zero. And you can have nice returns. Like, even if you just earn 7.2% a year, which isn't that big of a hurdle over the last 50 years, that means it doubles every 10 years. Like, that's fantastic. Like, you can double every 10 years just by earning 7%. That's awesome. But it's not the same as the other. And I think having that mindset is incredibly important, because once you've built a company, sometimes you think, well, why can't I do that again? And maybe you can do it again, but we're not going to do it for you. Like, you're not going to have some passive investment in somebody else's company that's going to do that, most likely, unless you're really lucky. But we have clients that are interested in doing that. Like, okay, why can't I find, the private, Google when it was private, or, DoorDash when it was private. And it's like, yeah, you can have that through venture capital investments, but again, it's not going to be one company. You're going to be diversified. So, through a private equity fund, a VC fund that we use, some of our clients had DoorDash, and that was like this amazing return. And they actually got shares of DoorDash when it went public, and that was awesome. And it really helped that fund's returns. But, that fund had 20 other investments. So while the fund did well, it's not like they had all their money in DoorDash, because you read it sometimes of like these, administrative assistants that work at these public companies that have 10, $20 million just because they got stock options in that one company. It's like, yeah, they were concentrated, not diversified. They worked at the company and they got lucky. That's why they have, $10 million. So anyway, I think that's an important mental model for people to have, especially business owners looking to sell. How do I adjust my view? And if I want to go start another company, how much do I put into the company versus how much do I keep in the boring side that's going to, hopefully double every 10 years?
Well, the reason I like to bring this up is because it's a mindset switch. It definitely is, because you're definitely, when you put everything, your time, your energy, effort, and you shove all the money back into it, you bootstrap it, or maybe raise capital to scale your business, etc. And you have, you own 80% or 60% of this business, and you sell it for 9 figures or whatever. You're then all of a sudden the mindset switches, right? Where, okay, now you want to position 70% into those boring things, right? Those consistent things that'll, pay your stuff and whatever. And then obviously take maybe 5, 10, 15%. This is something I had to learn. Actually, I was very struggling, because I'm one of those people that I'm like very optimistic, just like my human behavior. And I'm thinking, oh, if I invest, 30% of this portfolio and invest into this, I could see the return on it. But one of my wealth managers, he's like, well, what if it goes to zero? And you kind of exemplify that in the book as well. And I stress test it. And I was like, well, that's a good idea. what does my life look like if you lose all that money? Will it be freaking out, whatever? And being able to walk through that, having someone beside me help me unpack that myself, I realized that was a fault of mine. All I saw was this over here, and not seeing, the devastation, the destruction that could be. And I know we're getting to the end of our time here, but I know even in the book you talk a little bit about exponential growth, but also there's that exponential destruction as well, which is a very interesting conversation. And I wish we had more time.
Right.
I want to ask you.
And you got to look at the
Please go
odds,
ahead.
right? So the odds are, if you invest in a single business, the odds are is whether it's a public business or private business, is it's going to way underperform what you would get in the S&P 500. And you just got to know the odds. It doesn't mean that you never do something where the odds are against you. It's you go into it and you go, okay, the odds are against me, and do I have a good reason to go against the odds? And in our view, like in one take of my book, you could read and you go, oh, we should just index. And actually, that's what most people should do. But it doesn't mean you should always index. There's other reasons to invest against the odds, including it's fun. Including sometimes you do, invest in that unicorn or whatever. But you should go in knowing the odds. That's one of the key points that we make to our clients. And this skepticism, right? And regression to the mean and causation and causality, like knowing those things makes you a better investor, because it's not about the idea. Peter Thiel talks about this in his book, 0 to 1, that successful companies have secrets, and secrets are things that sound crazy. So like, I thought the idea of Venmo was like the dumbest thing I'd ever heard of. Social media and payment systems together, or SpaceX. When I first heard of that, like, oh, a private company competing with governments or huge aerospace companies backed by governments, that's the dumbest thing I've ever heard of. And the point we tell our clients is, when they come to us with these ideas to invest in these businesses, they usually sound like great ideas. And the point we make to them, because we believe it ourselves, is we don't know what a good idea is, because most good ideas sound outlandish. And most ideas that sound good are going to have too many competitors, right? So that's like this paradox that is so important to know as an investor. So there's all these other things when you're doing direct investing. There's all these other things that you have to look at other than the idea. But so many investors just jump straight on the idea. I love that idea. And they're sold on the story, because we love stories as humans. It's like, okay, I love this story, I'm going to do it. And you really got to go through and do all this other process.
Well, you go into a massive depth regarding like Kodak, where it went explosive and then all of a sudden just massive curve down. You also, same thing with Blockbuster and Netflix, and then you also mentioned the story aspect as well. How some prevalent people got defrauded by, and you go through a really really fantastic example. For those that want to know a little bit more about that, you have to buy the book. But I want to talk a little bit about this specifically, and I love this. I never thought of it this way, but you mentioned good decisions sometimes produce bad results, and bad decisions can produce good ones. And I thought that was just a cool paradigm, because it's so accurate. However, though, I want to ask, what was the journey of that evolutionary kind of thought? Where did that come from? I'm curious, because I just think love how you put that.
Well, I'll tell you, so it's interesting. Like, if I think back to my favorite investment books, there's at least one and sometimes 5 or 10 things I'm like, wow, that really affected my thinking and worldview. And so probably the investment book that's had the biggest impact on my worldview is one I mentioned in my book called The Success Equation: Untangling Skill from Luck in Business, Sports, and Investing by Michael Mauboussin. And, he really gets into this, something he calls the skill luck continuum. And I discuss this, my book as well, is that some things are decided completely by skill, like chess or, a running race. Like if I were to, jump in the pool against Michael Phelps or Katie Ledecky or whatever, they would beat me every single time. It's a skill-based sport. There's very little luck in it. I mean, you can have somebody that, misses a flip turn or whatever, but that's even more skill than it is, it is luck. Whereas you have things that are completely luck, like, the lottery or roulette or, slot machines, right? And then in the middle, you have everything else. So if you look at, I'm a huge hockey fan, and, sometimes, a team will hit the post like twice and then lose by a goal, right? So you have this big amount of luck that affects most things. And it's interesting, investing really falls really far on the luck side of things. There's just a huge amount of luck. And one of the things that in order decipher the difference between skill and luck is the more and more something's closer to luck, the more data points you have to determine whether it's skill or not. So in 2020, the highest performing portfolio in our firm was of a 13-year-old. So get this, we manage, at the time, I don't know, $13 billion or something, hundreds, 63 families, but hundreds and hundreds of portfolios. And this middle schooler had been given money by, I forget her parents or grandparents, and she had picked a few stocks. I mean, she'd picked Tesla because her friend's dad had a Tesla and loved it. And then, Apple because she loves her iPhone, and Netflix because she watched whatever TV show on Netflix. And in 2020, those were like 3 of the top 20 performing stocks for the entire year, And so we looked at the ranking and we're like, oh my gosh, she crushed it, right? And so it's not like you'd go out and hire, little Sophie and go, okay, Sophie, tell me what I should buy next. I mean, it just shows you how much luck there is in investing. And if you look now, all those tech names are down hugely now, right? And so it's got to be one of the lowest performing portfolios if that's what she still owns in 2022. And that's sort of what you would expect. So you need all these data points. And so what you have is in the interim, because of so much luck, is you can consistently make good decisions and still have bad results for a long time. And one of the biggest challenges in investing for investment managers and people in the industry is that investors are impatient. So if you're doing the right thing over and over and over, but you're getting bad results over and over and over, you'll be fired and you'll go out of business. So then people have to stop making those decisions they think are good and capitulate and be with the herd. And then vice versa. You have people like this 13-year-old that her decision-making process, arguably had no relevance, but yet she had this amazing result, and she could be like, oh my gosh, I'm going to, as a 13-year-old, I'm going to open up a business where I pick stocks for people, and then you could have people put stories around it. We want explanations. And it's like, well, no, like a 13-year-old knows what an entire generation of people like. So they're more in the know about what companies are going to do well because they know what all teenagers and adolescents want than somebody that's 40 years old and is an investment analyst. So maybe we should let 13-year-olds pick stocks. I mean, people actually start and jump to that because they want the world to make sense and they want an explanation other than it was just random.
Well said. And again, it's just understanding the human behavior, understanding our own, our biases, as well as just understanding kind of what we like to do. And you really lay this out tremendously in the book consistently over and over. And you do mention that that story. I appreciate bringing that up. I thought I was cracking up when you were saying that. I thought that was so funny. I want to, John. I really just appreciate you being on here today, man. Just unpacking this at such a deep level. I learned so much just from reading this. I remember one person in it said it's almost like realizing Santa Claus is not real, and you say that, and I think that's and one of the people that read it, and I think that's so accurate. Where you start realizing, okay, hey, but it allows people to become aware of their own biases, of where their own patterns and behavior, so that they can control it. And like you mentioned in that bullseye concept, right? What can we control? So, John, for those that want to, maybe even reach out to you, maybe they're in that situation where there's that minimum investment, or they want to be part of what you got going on, or maybe they want to just obviously get access to this book when it does release in May here. How do they go about doing that, John?
So if they go to my johnmjennings.com website, it has my contact information. They can send me an email. My work email's on there, and my cell phone's on there. Feel free. I also write usually about twice a week. It used to be every day until I started writing the book, but a twice a week blog called The Interesting Fact of the Day. So www.theifod for interestingfactoftheday.com. And I think there's also a link for my John M. Jennings. So I just write on stuff. So like today's is on the effect on worker productivity from the World Cup. So one of the things I point out is there was a study in 2012 that looked at data from 2010 during the 2010 World Cup. And they found that when in a home country stock market, when their home team was playing, that the number of trades during the game dropped by 45% compared to what they would be, and the volume dropped by 55%. And when a goal was scored around the time of the goal, trading dropped by another 5%. and just how many hours of worker productivity is lost by the World Cup. So I write on things that just random random things that hopefully people find are interesting. Love to gain more subscribers to that. Kind of writing that kind of scratches an itch for me. But yeah, if they go to johnmjennings.com, it's all things kind of related to me and my writing. And I write for Forbes, so there's Forbes articles and things like that. So
awesome, guys. Those links are in the description below. I'll make sure I'll link all that stuff down there that he mentioned. So go ahead and stop what you're doing and literally just be part of his ecosystem. He's got just tons of content out there, tons of blogs, tons of just resources out there for you to consume and just switch that paradigm, right? Switch that mindset and really go against that bias, go against that culture that we all want to be pulled directly with certainty and realize, okay, you know what, there's that uncertainty, and embrace the uncertainty a little bit. And so John, I really appreciate being on here and just the path that you had to go through and being able to take your years upon years of experience and putting it into this book and then putting it into so many of your resources as well. I always love to ask before I let you go, is there any last words of wisdom that you'd like to share with our audience?
Yeah, I will. So one of the, I've always loved to read, but really after the financial crisis, I really, I obviously, have to keep up sort of what's going on. And, I'm the chief strategist of a firm with, $15 billion of assets. But really what I started doing is reading more books, and not only just investing books. And I would just say that has made such a huge difference to me in terms of what I've learned, because it's this amazing thing. Like, these people write books, if they're nonfiction. I read a lot of fiction too, but people write these books, like they'll have this entire career, 10, 20, 30, 40, 50 years. And then they distill the key things they've learned into a book. And it takes you like 4 to 6 hours to read these things. And then you've gotten a window into decades of experience and learning. So, I know a lot of people in the financial industry or business owners, they spend all this time reading the Wall Street Journal and Financial Times and Bloomberg and all these things. And those are all great. But me shifting towards reading a lot more books has had this huge impact on, I think, my learning and kind of scaling that wisdom hierarchy of having more knowledge or even wisdom, which you don't get much wisdom from reading, daily or weekly news, usually.
And that is my friend, the author of this Uncertainty Solution, as well as the president and chief strategist at St. Louis Trust and Family Office, my friend, John Jennings. Guys, that is Journey with Christian D. Evans podcast. Until next time, be uncommon if you can. Yo, this is Christian D. Evans, Journey with Christian D. Evans podcast. We thank you so much for listening to this amazing episode. If you feel and you know that this was valuable to you, please show some love to our amazing guest by liking this, by commenting on this, by making sure that you do a nice 5-star review and just show some love to our guest. That'd be really awesome. Also, make sure you share this with a friend, a family, a colleague, someone that you believe would bring value to their life right now. And guys, we just want to say thank you again for just being part of our community. If you want to have more resources, don't be afraid. Go to christiandevans.com. You can actually schedule a phone call with me, or you can send me an email at christian.evans@beUncommonIfYouCan.com. That's christian.evans@beUncommonIfYouCan.com. Always love to hear some feedback and let me know what is the number 1 or 2 things that you are struggling in your business and your life, and we'll make sure we have those conversations. Guys, that is Journey with Christian D. Evans podcast, and until next time, remember, be uncommon if you can. Cheers.